When the silver stocks move, there isn't enough combined market cap among the legitimate ones to hold the money from the generalist investors. This isn't for the faint of heart. Use money that you can stomach volatility on. Be prepared to wait for 18 months or 2 years. But that's not too long to wait for a 10-bagger if you have the financial and psychological fortitude to take it.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for February 12th through February 19th, 2024, while supplies last. First, we feature backdated 1-ounce Silver Philharmonics at $3.15 over spot with a minimum order of 50. We also have pre-1933 gold $10 and $20 Liberties at $99 over melt and $145 over melt, respectively. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We are always delighted to have this widely followed returning guest, Rick Rule, the former CEO of Sprott Asset Management and now the CEO of Rule Investment Media, joins us this Monday, February 12th, 2024. Rick, thanks for coming back on Liberty and Finance.
Always a pleasure, Dunnigan. I enjoy these conversations and I enjoy interacting with your audience. So thank you for having me back.
And just to remind everybody in the audience, you have at least a couple ways to interact with Rick. One is by submitting questions ahead of this video, as many of you already have. So we're going to be fielding some of those pronto here. Also, Rick usually extends some invitations to send him some information about what you might be interested in, about your portfolio, about some of the things that he's investing in, et cetera, at the end of the interview. So that's another way, as well as just reaching out to Rule Investment Media. So, and we'll also talk about your upcoming major symposium, and we're right off the heels of your Bootcamp that we were talking about with you last month. So I'd like to hear a little bit of an update on that. But first of all, let's do that first. So you just did a Bootcamp. You've done several of them, one on silver, one on uranium, one on royalty and streaming. The one you just did was, as I understand correctly, was on exploration and development stage opportunities that people should be aware of. What's different about investing in that space rather than in production mining companies, that sort of thing? Can you give us any key takeaways that you think people will be wishing that they had attended and perhaps will make sure that they do next time you offer such a boot camp?
Let me begin by talking about the boot camps generally. The boot camps are 8 to 8.5 hour long online symposiums covering one specific area of natural resource investing. We've done commodity-specific ones like uranium, like battery metals, and we've done more thematic, like royalty and streaming or development stage companies. Development stage companies are sort of unique. It's after the exploration, by and large, has been done. When the company is engaged in production or pre-production, and it's useful in the sense that the exploration risk is out of the company. It's also useful because during this period of time, the press releases that the companies issue are fairly mundane and boring. So investors stop paying attention, and ownership transitions often from retail investors to institutional investors. But the institutional investors don't pick up the yoke, as you will, until construction is complete and until the companies have reached nameplate capacity. So the period after the bankable feasibility study, but before the attainment of nameplate capacity completion, is a period of time when many of these stocks become orphan. To the extent that companies successfully negotiate construction through nameplate capacity completion, it is not uncommon to see 200% price escalations because these stocks go from being orphan stocks to being institutional quality stocks. And if the company makes the successful transition without investment markets noticing, they are almost always taken over by other mining companies that understand the value. So this is a unique place to pay attention as a natural resource investor, one who is willing to come in before investment grade status, but one who wants to de-risk his or her holdings by coming in after the exploration risks have been incurred.
Well, I'm grateful for that reminder of what the scope of the conference was. Were there any key salient takeaways that you'd like to share with those who weren't able to attend the conference?
It's difficult to explain 8 hours worth of technique in a small interview. What I will say is that if you understand the concept, which is to say that boring is good as an antidote to terror, if you want money more than excitement, and if you understand the proposition that the shareholders turn over away from the exploration-oriented speculator towards the investment-minded institutional investor, and that there's often a 2-year period where lots of work is going on behind the scenes, but the market doesn't recognize it, then you will understand the value proposition. We presented one investment opportunity, G mining, and I won't go into G mining in detail, but it's always useful to have a company that investors can focus on. You can employ the lessons that you learn in the bootcamp in real time. I also need to say, Donegan, that it's very useful for people who want to attend the bootcamp to utilize the free resources at the Rule Classroom, including the 9-part series on analyzing mining companies, so that you can prepare your mind to absorb the information that we're going to teach you in the bootcamp. It's also important to know that even the most diligent student in the world can't absorb all of the information that we're going to give you in 8 hours. Understanding that, we make access to recordings of the bootcamp available for attendees for 12 months after the bootcamp. I think the final feature that I'd like to talk to your listeners about is that with regards to both our boot camps and our live symposiums, unlike any other educational content provider that I'm aware of, we have a gold-plated money-back guarantee. If you didn't feel that you got your money's worth from either our symposiums or our online boot camps, we will give you a full refund, no questions asked. Nobody else that I know of has enough confidence in their material that they're willing to do that.
Well, folks, and we're going to keep you informed of any of Rick's upcoming boot camps, and we also want to give you a save the date for the major symposium that's at least 4 days long in late July in Boca Raton, Florida. So we'll touch on that at the end of the interview as well. Rick, I wanted to bring our focus way up to the macro view of above ground availability of some key precious metals. Silver, I guess in particular, is being brought into attention because of some publications of the Silver Institute that are highlighting a burgeoning shortage of silver. And you and I and Keith Neumeyer from First Majestic Silver interviewed together a while back. And the title of that interview was Massive Metal Shortage Coming. And Keith and you were both basically laying out the proposal that the industrial demand and from many different sectors for metals, given so many, I guess, trends in our macro economy, will be far expected to, the availability of mineable silver because of the decade-long dearth of exploration and development, that sort of thing. And would like to see if this is showing any signs of coming to a head. Some people have said, well, all it takes is a good recession or depression to put the damper on that industrial demand, and so maybe it'll all just average out. But recently there's been a number of articles coming out saying that, for example, silver is in a massive 4-year deficit among spikes in demand for satellites, rockets, missiles, bombs, aircraft, spacecraft, solar demand in China alone to reach 1 terawatt, and so on. And where's all this silver going to come from? There's been some speculation that China and Russia seem to be able to take care of themselves quite well with their own domestic supplies, but maybe that's not the case. And whether that's whether we're so busy myopically focusing on the COMEX and the LBMA storehouses that maybe aren't the place to be looking for where the above ground stockpiles are that are going to feed this supply, if there's actually an imbalance between supply and demand. So could you let us know what your big view is of the update?
Dunnigan, that's the longest question in human history.
Well, unfortunately, that's one of my weaknesses. So give us an update on your thoughts.
I'll do my best to unpack it. First of all, I'm delighted with the information from the Silver Institute, because neither Keith nor I have the resources to understand anything like the totality of the silver market. At the Silver Institute, they have a bunch of smart young researchers who do nothing else full time. And the report, which I've studied in some detail, is an interesting read. It talks about the fact that there's a primary deficit for 2024 of approximately 1.2 billion ounces. It's important to note that the report doesn't attempt to categorize above ground inventories for the simple reason that nobody knows. A whole bunch of silver constitutes private wealth, particularly in South Asia. When people hold private wealth to shield themselves from their government, they very seldom identify that private wealth to the government. So we don't know what the above ground inventories are like. What we do know is that the low price for silver has made primary silver mining, that is to say, silver produced from silver mines, uneconomic or marginally economic in most cases. Most silver, in fact, is produced as a byproduct of copper mines, lead mines, zinc mines, or gold mines. And it is true that a recession, which reduced copper, lead, and zinc production, would probably have a deleterious impact on silver production. But silver demand might fall too, which is to say, if you are concerned about a recession, be concerned about the silver price. It will be a mixed blessing. It will reduce supply. It might reduce demand. It is important, though, to note that the low silver price right now depresses the biggest source of silver production, which is recycling. For many industrial applications, at $24 or $25 silver, the value of the money recovered in recycling operations is not enough to justify the recycling. And the industrial uses of silver are growing very rapidly. Its reflective properties and conductive properties make it absolutely a necessary component of solar energy, hence the Chinese fascination with silver. But importantly, too, silver is a wonderful germicide, and there are very rapid increases in utilization in water and wastewater treatment, in sanitation, and in medical. Maybe the fastest growing application that we're seeing with regards to silver happens here. It's also important to note, though, that the quantum increases in silver price that we've seen occasionally in the past are really a function of investment and speculative demand. We've noted on your show before, Dunnigan, that historically precious metals bull markets are led by gold. They're led by the fear buyer. And when the narrative gains popular currency among generalist investors, that commodity with a lower unit price, which is to say silver, begins to move further and faster. So I think silver speculators will need to watch the gold market. I think it's important, too, to note that in every currency other than the U.S. dollar, we're in a gold bull market. So I think that's important to understand. I think I've covered every point in your question, but at age 71, perhaps my memory failed me.
Well, one of the aspects of the question was how in the world have we been able to even meet the demand so far, given that it seems that the industrial demand has outstripped the production of new mined silver for the past several years in a row, and where is the silver coming from to fill that gap between the supply and the demand?
I suspect that you are continuing to see leakage of physical silver inventories held by individuals, particularly in South Asia, India, Pakistan, Bangladesh, Sri Lanka. Those societies have a millennium-long fascination for silver. They have a need for a store of wealth outside their domestic currencies, which are inflated away. And the consequence of that is what the silver price does well in their own currency rather than in the U.S. dollar. They often dishoard that silver to use to meet household expenses and things like that. The silver market is devilishly tough to forecast because you have to know an awful lot about a lot of things. You have to know a lot about copper markets and lead markets and zinc markets. You have to know about the economy of India. Things like a drought can actually impact silver supply as peasants dishoard their silver to feed their families. So it's important to note that even an organization like the Silver Institute that has all of the resources which it can employ studying the silver market can very often be wrong.
Do you have any reason to suspect that there may be revelations of basically claimed silver that isn't actually there? John Cruikshank, 3784 asks, ask Rick if he thinks silver will be exposed as uranium warehouse shortages have been.
I don't know about the extent that will happen, that could happen. You and I have talked before, Dunnigan, about the fact that futures markets and silver paper markets often trade 200 times in a day the amount of silver available for physical delivery. Mostly, these trades don't settle in physical. Mostly they're rolled over, and only the differences are settled in physical. You could have a situation where you had a seller default, and that would be a truly ugly thing. Now, don't think that you're going to get a short squeeze, a real short squeeze. What will happen is that the exchanges likely will shut down for a while, and they'll cash settle. But they'll cash settle if that happened at a price much higher than today's price. So what really bothers me is that you have a market where the sort of gross trade position is in the billions of ounces, and the physical silver available for settlement is in the 60 or 70 million ounce range. You have the possibility for a truly severe disruption given the extraordinary leverage in the silver market. And by the way, many of the things that silver bugs traditionally identify with silver price manipulation have to do precisely with this. I'm not a believer that there's a decade-long or 2-decade-long or 3-decade-long conspiracy to manipulate the price of silver. But I note that trade desks manipulate every market, including markets as broad as the euro dollar, the euro, and the US dollar. Manipulating the silver market, where you take a leveraged position, long or short, in the futures market, which is often levered 300 or 400 to 1 against the physical market, and then using borrowed physical silver to dump into the physical market at some point in time during a 24-hour period, where the trading volumes are fairly small. In other words, you maximize the amount of damage that you do to the physical market to maximize the leverage gain that you get in the futures market. I think that's been happening continually for about 20 years. The temptation to do it where you can sell, say, $50 million worth of silver, which you have to pay interest on, to move the silver market 5 or 6% down, and then have that 5 or 6% reflected in a futures market where you have a $500 million or $1 billion leveraged long position, means that you can, if you play your cards right, generate a 50% return on capital employed in a 2 or 3 week period. The temptation to do this is, of course, extraordinary, and the leveraged function of the futures market makes this fairly easy for deep-pocketed players, sophisticated players, to accomplish.
You've been consistently critical of governments in general and regulation or lack of proper enforcement of things that should be looked after. Is this one of the areas you feel that regulators have been neglecting, is these concentrated positions that can result in these distortions in markets like this?
I don't think so. I think it's above their pay grade. I wish they'd focus on educating the kids and deliver the mail. What I think is dangerous is that retail investors actually believe that they're protected by the FTC and the commodity futures trading authorities. It is beyond their scope. They can't do it. You need to protect yourself. So don't look to the government to be protected by. Look to yourself to protect yourself from, not by, your government. And take care of yourself in markets.
Now, as far as protecting yourself from your government, the government is certainly involved in the destruction of the currency value worldwide. All fiat currencies have been going, down in value, in purchasing power. Excuse me. You've in the past talked with us about maintaining cash liquidity be ready for an opportunity, or also maintaining bullion liquidity. Can you give us an update on your stance on that, or why people need to be listening to those words in a new way at this time as we enter this season?
Virtually unchanged, Dunnigan. A financial planner would look at my estate and see me as the largest shareholder of Sprott, and a fairly substantial investor in mining shares too, and saying, why on earth would Rick Rule own gold? He's highly leveraged to gold's future. I own gold as an insurance asset. I don't own it because I think the price might go from $2,000 to $2,270. I own it because I'm afraid of a circumstance that would take the nominal gold price in US dollar terms to $8,000 or $10,000. I buy it as insurance. And like any other insurance class, I actually hope I don't get paid on it. Think about it. Life insurance means somebody that died. Auto insurance means your car got stolen or wrecked. I own gold not because I'm greedy, which I am, but rather because I'm fearful. I consider gold to be good if volatile liquidity. I also maintain US dollar liquidity, despite the fact that I think the real rate of inflation is much higher than the stated rate of inflation. And that means that the spending power that I enjoy for the cash I save is declining, despite the fact that I might be getting a 4 or 4.25 yield. I do it because I believe that the negative yield, the difference between the decline in the purchasing power and the rate of interest that I get on my savings, I regard that as an option premium. I think that having cash will, if we experience a liquidity crisis, circa 2008, give me both the tools and the courage to take advantage of that circumstance rather than being taken advantage of by that circumstance. So I continue to hold both gold and short-term US dollar denominated savings products for liquidity.
You've described yourself at times both as a speculator in the past and as an investor more recently. People who are holding physical silver or have investments that are tied to the price action of physical silver, and as you've talked about how silver tends to move farther and faster later in the bull market cycles, as you've seen in the last several bull markets with precious metals, people who ask questions like we've gone asking, where do you see silver by the end of 2024? But rather than picking a price target, you've talked to us in the past about just positioning yourself in unpopular positions and waiting for the market to prove you right and then going ahead and stepping out. But maybe partly that question might have buried in it where you see, or what signs in the tea leaves you would be looking for to start exiting a position when the market has proven that you were wise to position yourself in it.
What I find is when a topic becomes popular, the easy money has been made. You and I talked 3 years ago about uranium, Dunnigan. To the collective yawn of most people. When the price of uranium was at $20 and had to go up, nobody wanted to own it. Now that uranium's at $100 and it doesn't have to go up, everybody wants to own it. When I see silver on the cover of Barron's magazine or something like that, when I see all of the scampsters that are, currently selling psilocybin stocks or AI stocks or lithium stocks crowding into the silver space, I'll be looking to take my exit. Yes, by the way, I have sold some uranium stocks. When a commodity goes from hated to unhated, it doesn't have to go to loved. When it goes from hated to unhated, the easy money has been made. Silver disappointed so many newcomers during the silver squeeze. And by the way, there's nobody angrier than a jilted lover. That it's truly hated. When I look at the comments that will accompany this interview after it's been published, many people will say, I can't believe this guy's droning on about silver. It hasn't done anything. That's precisely why I like it, because it hasn't done anything. I like it because there's no competition. I want your viewers to look at me, look at my face. I'm a 71-year-old, bald, fat, aged male. And I can win the 100-yard dash if I'm the only guy that shows up to run. I love markets where I have no competition, and silver is a speculative market that's just that. And the silver stocks themselves are even more beat up, which is even better. They're a higher leveraged, more speculative, more alpha-oriented play, not for weaklings. not for people who don't have the courage of their convictions over a long weekend. But the truth is, Dunnigan, and I've cited these statistics on your show before, when the silver stocks move, there isn't enough combined market cap among the legitimate ones to hold the money from the generalist investors. And you get moves like the silver standard move, 75 cents to $45, like the Pan American silver move, 50 cents to $40, or the granddaddy of all the silver stock moves in the 1970s, Coeur d'Alene mine, 10 cents to $65. Not a typo. Now, this isn't for the faint of heart. Use money that you can stomach volatility on. Be prepared to wait for 18 months or 2 years. But that's not too long to wait for a 10-bagger if you have the financial and psychological fortitude to take it.
I was just re-listening to an interview you did with you interviewing Keith Neumeyer ahead of this last July's Rule Conference or Symposium on Natural Resource Investing, where he was describing the plight of the unloved aspect of mining company stocks and how the ratio of the asset itself, for example, silver itself to the silver mining company stocks has never looked more obvious that the mining stocks are undervalued. Can you bring us up to date on your views of that as far as a contrarian investor considering dipping their toe into silver mining stocks at this time?
Well, I disagree with some points in Keith's analysis because he looks at it from the point of view of a silver miner. It's important to note that silver miners produce about 18% of the new mine supply. Silver miners exhibit precisely the tendencies that he talked about. If, however, you are a copper miner or a lead miner or a zinc miner and silver is a byproduct for you, the truth is that the silver price doesn't matter much to you. So it's important to differentiate what Keith said with regards to silver miners relative to miners in general. What that means, though, is that during periods of shortages, even though the silver price goes up, silver production doesn't go up that much. Because, as an example, if the copper price was down and the silver price was up, copper production would fall, which means byproduct silver production would fall as opposed to rise, which you would expect in a rising silver market. So it's important to look at the whole circumstance, not just the circumstance as described.
You mentioned a little bit earlier about using metals to protect yourself from your government. And a lot of our clients and our viewers are trying to do just that. We have a related question, and you've addressed this. The last time I think we spoke about it explicitly was after Trudeau's actions following the Freedom Trucker rally in Canada about a year and a half ago. But there's a question from Peggy Lohman who says, are vaults safe from confiscation from the government, such as precious metals IRAs? And there's another one in here talking about, are people, everyone talks about taking your 401k IRA, rolling it over into gold and silver. And what about annuities? Are they in danger? So two separate questions, but both on this idea of protecting yourself from danger by trying to get out of paper assets and into real owning of real assets.
I think that topic is best understood in terms of probabilities. I believe that the ownership of physical gold and silver at home, what I laughingly call midnight gardening, is riskier, particularly if you talk a bit, because you run the risk of somebody coming to visit you that you wouldn't normally have over for lunch. So there's a range of risks. I also think that the risk of government confiscation, physical confiscation of your IRA or physical confiscation of your precious metals in the intermediate term, which is to say the 5 to 10 year term, is very low. The government has many more efficient ways to steal from you, and you admire them for those forms of theft. Taxation is theft. But to the extent that the government taxes particularly somebody else, their constituencies love it. Inflation is theft, but rising price levels are regarded by many people as evidence of economic prosperity. Quantitative easing, the printing by the government of specious currency units unbacked by anything, is theft. But people like the government to create money so that they can shower them with benefits that they don't deserve. Excessive government debt is theft from a future generation. Governments thrive by stealing, and they would prefer to steal in ways that the populace approves of. Remember that there are 400 million guns in private circulation in the United States. I don't think that the government would risk the wrath of people by coming to their front door and stealing from them directly, confiscating their IRAs or making them invest their IRAs in government security, confiscating their physical gold and silver. They won't do that. They'll increase the debt. They'll increase inflation. They'll increase taxation. They'll increase quantitative easing. And ironically, the voters will reward them for it.
You've talked with us several times in the past about the elements of being a contrarian investor. And as you look at the landscape that we're facing right now and the major trends that are in place, are there areas that we haven't spoken about in the past? One comes to mind that was raised by a viewer. I thought it was a gag until I thought about the question a little bit more. He said, ask Rick if this is the time to be investing in chocolate bars rather than gold bars. And I thought, oh, that's a gag question. I thought, wait a minute, it's not. There's a cocoa shortage and all this sort of thing. Cocoa reached a 44-year all-time high in October or something. So are there any areas we haven't discussed in the past that you think people who want to take a contrarian approach should be paying attention to at this time?
Agricultural commodities are notoriously volatile, and what can be short this year, next year can be in surplus. So unless your viewer is particularly dialed into agricultural commodities, he or she should avoid that sector like the plague. And chocolate bars don't store well. A gold bar will hold its value for a very long time. A chocolate bar, irrespective of the price of chocolate, will deteriorate to the point where it becomes inedible. So you probably don't want to do that. The broader question around commodities, there are not many commodities that you and I haven't talked about in the past. So finding one that we haven't talked about, I think, is difficult. I believe that gold is underowned. I believe that because gold performs well during periods of time when people are concerned about the maintenance of their purchasing power in fiat currencies, and because we've gone through 40 years of benevolent economic climate, that too many people own long bonds and not enough people own gold. They're looking at the performance over the last 40 years and extrapolating it over the next 10, which I think is a real mistake. So I think that contrarians should increase their gold holdings. Dunnigan, we've talked before about the fact that the market share of precious metals and precious metals securities in the United States relative to total savings and investment assets is less than 0.5%. The 2-decade mean is 2%. I believe that precious metals will revert to mean. And I believe, no guarantee it'll happen because I believe it, but I believe that this resumption of market share will occur over 5 years. If I'm right, that means demand for precious metals and precious metals related assets over 5 years will quadruple. Your guess is as good as mine as to what will happen in terms of price. When that happens, these will no longer be contrarian strategies. They'll be mainstream strategies. And I will likely sell some of my holdings as they go from being hated assets. I also believe that carbon generating assets, which is to say particularly oil and gas, but also coal, are roundly hated and very necessary and very cheap and yielding very, very, very good current yields. I think most investors, including most institutional investors in the United States, are stupidly underexposed to the oil and gas business.
You must be reading my screen. I don't know how you're doing this because we have a question I was queuing up next for you from Daniel Hernandez Torres. Says, fossil fuels aren't going away anytime soon, and Rick loves hated commodities. What does Rick think about carbon offsets and companies such as Base Carbon and carbon streaming?
I don't know enough about carbon markets yet to talk about carbon offsets. The carbon that I was referring to wasn't offsets, it was carbon generation. I'm very concerned about the small independent carbon companies because I think they'll have to compete head to head with Goldman Sachs and Trafigura and people who have much more capital and much more experience in markets. My suspicion is that the current crop of independent carbon companies in the next 5 or 6 years will get their asses kicked. And I don't think that investing in carbon offsets or carbon credits is a contrarian activity at all. I think investing in carbon is the contrarian activity. I understand the narrative around carbon offsets, and I understand how the markets are supposed to work. The problem is that isn't the way that the markets are working. The environmental community has done a great job in getting set-asides in carbon for conservation projects worldwide. They assign a certain amount of carbon generation to a rainforest in Congo and Brazil, and then they sell credits based on that. Very recently, the audits of carbon stored in soil in these carbon offset areas have suggested that the offset capabilities that have been charged by the conference promoters can exceed by 90% the amount of carbon that has actually been saved. So I think it's going to be a very interesting sector for the next 10 years, one that I will avoid, not because I don't like the narrative around the sector, but rather because I don't understand the reality well enough. And my suspicion is in those markets, if I go to compete with Goldman Sachs or Trafigura or Dreyfus or somebody like that, they're going to kill me.
There's a related question before we leave this topic and talk. Let you tell us about the upcoming symposium. SBren2527 says, looking to invest in oil and gas beta, considering buying XOM, CVX, OXY versus an ETF like XLE. General consensus is that ETFs are safer, but I have a hard time giving more assets under management to woke firms like BlackRock. With that said, which stocks in oil and gas represent the market beta?
It's arguable that somebody could establish an oil portfolio with Exxon just by itself. They have been year in, year out, one of the best capital allocators in the oil space worldwide. Unlike many of their peers, they pay a high current yield while at the same time reinvesting enough money to sustain production. Many of their peers are reducing capital spending in order to increase the dividend, which means that their dividend isn't sustainable. But at Exxon, the dividend is. In addition to maintaining sustaining capital investment, they just doubled down on their basic business by buying Pioneer for $60 billion. While the rest of the world doesn't want to be in the oil industry, it would appear that oil men, in fact, do. And importantly, too, Exxon has made a series of discoveries in South America, in a country called Guyana, that is profound enough at 11 billion recoverable barrels to move the needle on Exxon itself. Now, if you look at Chevron, statistically, it's cheaper than Exxon, which is why Warren Buffett has been buying Chevron rather than Exxon. I wouldn't discourage either, frankly, but I personally would overweight Exxon because I think it's a better company with better fundamentals. Occidental Petroleum is another one of Buffett's bets. He bet on that because he believes that U.S. upstream, which is to say, oil and gas production is cheaper than refining and marketing. And Occidental gives you a purer play on U.S. production, particularly, of course, after buying Anadarko. And I wouldn't argue with that either. I would just argue that Occidental, relative to the rest of the industry, is less undervalued, if only because of the Buffett aura of success and people following him into the stock. The overall question, which is to say, should you be invested in oil, is yes. Whether or not you buy it in an ETF, which I don't think you need to do, or buy it directly. The truth is, if you bought Exxon and Chevron, and if you wanted to add some political risk, some of the third world national producers, you could get 90% of the beta that you would get in an ETF owning 4 or 5 names, and you wouldn't have to pay BlackRock 40 basis points in management fees. It's really a function of what you want to do with your own money and how much work you want to do. What's important is to get in the game.
Before we let you go, Rick, could you give us very brief summary of what people will be able to anticipate if they consider attending the upcoming Rule Symposium on Natural Resource Investing, your flagship symposium in Boca Raton, Florida this July?
Well, the first thing is you'll get to meet Dunnigan Kaiser live in person, which is a rare treat. The Natural Resources Investment Symposium in Boca Raton, first of all, has stood the test of time. I don't know how many we've done, but it's got to be close to 30. So it's a conference that has stood the test of time. It is, I believe, the most important natural resources investment conference, at least for individual investors, on the planet. It's important because we combine great big picture thinkers, the Jim Rickards of the world, the Bill Bonners of the world, the Daniela DiMartina Booths, the Nomi Prinzes, the Grant Williams, people who give you a picture of the way it really works, not the way that CNBC and the big thinkers and the government would like you to think it works. Once we've established this worldview, we have assembled literally the best portfolio analysts and managers in the world around the industries that we think will do well as a consequence of this different worldview. Importantly, too, Dunnigan, we've assembled a group called the Living Legends, which are entrepreneurs who have built multi-billion-dollar natural resource companies from scratch. It's important to learn the lessons that they teach about how they built the companies and how the lessons that they've learned over 4 decades of building these companies have made them better investors and can make you a better investor. Probably the most important feature is that at every other investment conference I know, the exhibitors are treated as advertisers, which is to say the qualification to be an exhibitor is a check that cashes. At our symposium, our attendees have told us that the exhibitors are content. That means that every exhibitor, every public company exhibitor that's there, needs to be owned in accounts that are owned or managed by me. Sadly, it doesn't mean that every stock I buy goes up. What it does mean is that we have vetted every single company that's there. And every bullion dealer that's there has to have a track record of having no company complaints that came to my attention while I was in the retail investment business. Any bullion dealer that is at my conference has to have not one customer complaint lodged against it to me. That is no guarantee that your relationship with a bullion dealer at my conference is good. The only guarantee is that the dealers who are there have had literally millions, sometimes billions of dollars of transactions in the 30 or 40 years that I've interfaced with them and have had no negative complaints that have come to my attention. What that means is that the exhibitors here are, unlike other conferences, vetted. What all of that means, Dunnigan, is that anybody who comes, one more thing, you will have access to the conference tapes. The whole thing is recorded. You'll have access to the tapes for a very long time. You can attend this conference live in person in Boca Raton, or if you're unable to attend in Boca Raton, you can attend the course in the comfort of your own home on your computer by live stream. In either case, you'll have access to the conference recordings for a very long time. And finally, we're confident enough in the value proposition that we absolutely, positively will refund your tuition if you don't think that we've delivered sufficient value. Absolute guarantee.
Now, you've got another boot camp coming up shortly, and that's on prospect generators. Those two words have probably not been used together in any sentence by many of our viewers. Can you explain to us briefly what a prospect generator is and why they should attend the upcoming boot camp?
This boot camp is for speculators. This is all about front-end exploration. And front-end exploration, the risky part of the exploration, is the most under-owned part of mining, which is itself an under-owned business. It is where the most risk is and where the most reward is. Statistically, the least risky part of the riskiest part of mining are the prospect generators, people who use their technical acumen and their business prowess to originate and stake mineral claims, which they then farm out or sell to other companies. In other words, they use their intellectual capital rather than their physical capital. I have over 35 years invested in something like 70 prospect generators, and I have enjoyed 22 successes, which is to say I've enjoyed about a 30% success rate. In an industry where academically they teach you that 1 in 3,000 mineralized anomalies become to mine. So I have enjoyed a 30% success rate in an activity where 1 in 3,000 is the expected success ratio. Truly an astonishing difference. We will get very deeply into exploration techniques, exploration speculation techniques. We will have 2 keynote speakers. Either of the keynote speakers' talks will be worth the value of attendance all by itself. Once again, this is live streamed. You can watch it from your own home. You can play the tapes again and again and again, and you'll have to, because we're going to give you more information in 8 hours than you can absorb in 8 hours. And we'll do all this for $99 with an absolute gold-plated money-back guarantee.
And in the past, you've offered also to rank natural resource portfolios of our viewers. Are you willing to re-up that offer at this time?
That still happens, absolutely. If you like the way I think about natural resources and you want me to think about your resources, go to my website, Rural Investment Media. List your natural resource companies. Please no crypto. Please no tech stocks. Please no pot stocks. Just natural resource stocks. I'll rank them 1 to 10, 1 being best, 10 being worst. I'll comment on individual issues where I think my comments might have value. And by the way, while you're there, if you're an accredited investor and want to know what private placements I'm participating in, write private placements. I'll put you on the list for free. And furthermore, if you're an American or Canadian and you are unhappy with your current bank, many people know I have a new banking organization, Battle Bank. In the question and comment section, write bank, and we'll put you on the waiting list for a sanity-based bank.
Well, that's going to be something that we're going to have to talk to you about next time, which is the health of the banking system and why people might want to get their feet on more solid ground than they currently have. But we're out of time for today, and we're grateful for you spending this much time with our viewers. As always, folks, if you don't want to miss a single interview with Rick or any of our other guests, make sure you get on our free mailing list by going to libertyandfinance.com. Just put in your email address, click submit, make sure you confirm on the confirming email, and you'll get 1 email per day in your inbox with our latest interviews, including all of our interviews with Rick, and all of the links that Rick just mentioned will be in the description of this video. The link to the Bootcamp on prospect generators, the link to the Rural Symposium on natural resource investing coming up in Boca Raton, and the link to where to go to get your portfolio ranked for free. Rick, on behalf of all of our viewers, thank you for joining us here on Liberty and Finance.
Dunnigan, thank you for having me back. I look forward to seeing you in Boca Raton.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for February 12th through February 19th, 2024, while supplies last. First, we feature backdated 1-ounce Silver Philharmonics at $3.15 over spot with a minimum order of 50. We also have pre-1933 gold $10 and $20 Liberties at $99 over melt and $145 over melt, respectively. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.